This section is called Keeping You Covered, and Keeping You Covered is all about understanding different insurance products and how to keep you covered. So what's an annuity? What exactly does it cover? We know auto insurance covers cars, we know homeowners insurance covers homes, we know life insurance covers lives. So what does an annuity cover if it's an insurance product? Well, annuities cover your income. It's a way to protect your income. But much like other types of insurance, you get what you pay for. So if you don't pay a lot, you don't get a lot. This morning, and we want to get this right, that way we know exactly who we're talking about. This morning, Craig Hemke, which is the founder of buyapension.com. I've got it frozen up on the screen. We just reviewed it before we started this segment. He basically told everyone that you shouldn't own stocks and you shouldn't own bonds. He laid out the risk for stocks, which are obviously apparent. He laid out the risk for bonds next year. We all know that rising interest rates mean lower bond prices, and so therefore, somebody who has a portfolio of bonds in a rising interest rate environment will see a decrease in their principal value, something that obviously you don't buy a bond for in the first place. So today we're talking about the insurance product annuities and where they play in. And I have to say, it was basically a sales pitch during the segment. You could really, when he was asked by Mandy Drury, so what should you own if you can't own stocks and you can't own bonds? And I have to tell you that it was like watching a football game. I wanted to start screaming at the referee. I cannot believe it was like somebody launching a softball. So of course he responds, well, Mandy, we think people shouldn't be in either. We think they should be in annuities. And so let's talk about that, because it's really important for people to understand what it is when somebody says an annuity. An annuity is a fixed product that you exchange an amount of cash, and in exchange for this cash, they give you a fixed payment. He actually said, Craig Hemke, sorry, I want to make sure that we refer to him, Craig Hemke from buyapension.com said that an annuity was much like Social Security. Well, how is an annuity like Social Security? Well, you pay into both of them. As you work, you are forced to pay into Social Security, and then when you get to a certain age, 62, you're allowed to file and receive back Social Security income, and a lot of people unfortunately use this to live off of in retirement. Okay? Now, Social Security actually adjusts upward for inflation. So if there's bad inflation in a certain year, your Social Security actually goes up by that certain percentage automatically. Okay? To get that same type of benefit in an annuity, you would actually have to pay money. So that's the first difference between Social Security and annuity. In order to get the benefits of in order to protect against inflation in an annuity, you would have to pay for what's called a rider. This costs extra money, which eats into the dollars that you're actually giving the annuity company. Okay? Second thing is, if Social Security, if people have not paid in enough money, the government will just keep on paying out Social Security. So if you fail to plan for retirement and you're living off Social Security and Social Security runs out, which we've heard endless conversation about the Social Security Trust Fund going bankrupt, well, all the people that are working now, it's basically like a massive Ponzi scheme. So younger people pay into Social Security, and then older persons get that money, and as long as there's enough younger people working, then Social Security will be there for you. So the younger people might not ever necessarily realize the benefit of Social Security, but at least the people that are getting it now will. So that's a huge difference. In an annuity, if you don't save enough money on an annuity, that's it. You get whatever payment they'll guarantee you. So, for instance, let's take a look at if somebody had $100,000 and put it in a fixed annuity paying 3.3%. That's better than you're getting in money markets and CDs right now. It's better than you're getting in most of the treasuries, except for some of your longer dated treasuries like the 30-year. You get $270.93 a month. Now, I want all of us out there listening to this broadcast to consider what we would buy with $270 a month. Personally, that doesn't cover my mortgage. In fact, $270 a month doesn't even cover my groceries for the month. Now, true, I have 3 children, and when I get older, hopefully my children will not be living at home, which means that the food budget would be less. But we're talking about you would have to save up $100,000 in order to get the benefit of $270 a month. So let's take a look at $200,000. $200,000 is $541 a month. Okay, so that's the guaranteed income that you'll get based on $200,000. And let's just jump up to $500,000 and see what $500,000 gets you. Okay, $500,000. You would collect $1,354.63. Now, could you live off that? Well, if you had a paid off home, if all your cars were paid off, if you didn't travel, and you watched your expenses, you could probably live off $1,354. But if you compare your lifestyle to, say, almost anyone else that you could think of with $500,000, you probably live quite a bit below. And the reason is when you sign that contract for an annuity and you hand over this money, there's a period at which you are highly penalized if you withdraw the money out before that time. So in this particular illustration, it's 10 years. So for 10 years, if you want your money, you're going to suffer in the first couple years a better than 10% penalty, meaning if you put in $500,000, you're going to get penalized $50,000 for removing your money. Because what happens is the annuity company then takes your money and goes and invests it. And that's how they make money off you. You promise to receive a very meager interest rate of 3.3%. They go and they put it in their investment account, and then they basically, it's kind of like a bank. The bank borrows from the federal funds rate at 0. They go out and they buy treasuries and they collect money on the spread. They do the same thing with mortgages, really all products. CDs, bank takes in money on a CD, they go out, and as long as they're making more interest or more return on the money, then it makes sense for them to do it. So annuity companies are not out to help you. Now, are they helpful products? You know what? The reason that they're still around after 100 years is because they do serve a segment of the market that needs a particular product. But for this gentleman, let me get his name one more time, Craig Hemke, founder of buyapension.com, to come on and say you can't own stocks and you can't own bonds, you need to have an annuity. I'm sorry, frankly, that just sounds like a sales pitch, and it's my job to educate you in keeping you covered on how to protect various things that you have. Please, before you get an annuity, you need to consider all the circumstances. One of the things that Mandy Drury pointed out is, why wouldn't you just simply have somebody manage your portfolio? Get out of mutual funds, right? Get into individual bonds, individual stocks, commodities, futures, ETFs, all the stuff that's available. That was her question, and he never answered the question. He basically said, Mandy, bonds are scary, stocks are scary. We can help people buy their own pension fund. So, just know what you own. That's always really the goal with any insurance product, is to make sure you read the fine print, you ask the questions, know that there are lockup periods and that there are huge financial penalties for removing money from a guaranteed annuity. Every product has its place. So those are the facts on annuities. If you have specific questions, go to www.magnumopusfinancial.com. There's a contact us section. This is not specific advice. This is general advice explaining what annuities are and some of the drawbacks on annuities, some of the things that were not covered on this, basically a commercial live on CNBC, rather than explaining to you, what you should do to navigate your way through the market. So if you have specific questions about your situation, please contact us on the Contact Us section of magnumopusfinancial.com, and then we can get to you with specific things for you, because really all financial advice needs to be done on an individual basis, and rarely does one thing fit anyone. So thanks for joining us today on Keeping You Covered, and we look forward to seeing you in the future. All right, Happy New Year.